Asset correlation and benchmark. Nicholas Robiner in last year 2020 has analyzed the private equity returns with that of public markets using data from Cambridge Associate Factor Research. The analyses were done on the returns of private equities as compared to its equivalent public markets and Standard and Poor's 500 returns for the period 1994 to year 2017. The outcome of this study showed that the private equities outperformed its public counterpart from the year 1994 to year 2005, but not much thereafter. The average alpha fell from 8.9% to 1.9%. Historic return from private equities never became negative during this period. S&P 500 had 4 downward years. Internal rate of return accounts for the time and private equities is a liquid asset simply divest and sell in a listed stock. Time is very important for private equities, and internal rate of return is one of the key measures to use for private equity return. Internal rate of return distinguish between 1 year period and longer years time horizon. Historical trend and performance. The years from 2013 to 2018 showed a golden age of growth in private equity due to fierce competition and the rise of prices. Buyout value jumped by 10% to 4,582 billion, resulting the strongest 5 years in the industry history, as shown in the next graph. This graph shows the years from 2013 to 2018, how the growth of private equity has taken place. Cambridge Associates showed that the private equity market produced an average annual return of 10.48% over the 20 years period, ending on June 30th, 2020.
Future trends expected to impact private equities. The demand is increasing for private equity investments. Consumer preference indicates about 66% of institutional investors in 2020 have current investments in this space, with this number expected to increase from new regulations allowing smaller capital commitment retail investors access to these markets. This year, 2021, private equity markets are positioned to be an active year for creating investment opportunities as a record high dry powder, combined with an anticipated increasing demand, should drive a higher rate of acquisitions. COVID-19 slightly slowed down deal activity in the early stages of the pandemic, but rebounded and picked up again in the second half of the pandemic year. An integration to a virtual-based platform aided the relatively quick recovery. The pandemic initially disrupted this industry heavily due to the fact of private equity being an industry in which relationship building is very impactful. The lockdown, travel restrictions, and remote working hindered the ability to build these strong relationships amongst investors. The transition to digital platforms has since helped to aid the recovery of private equity investments by creating a new virtual communication and investing techniques.
COVID-19's impact on private equity. COVID-19 has caused portfolio makeup to change in the whole financial industry, thus the private investors' assets under management. Diversification has become even more pertinent. Lending frequencies are vastly dispersed, and credit has become a more integral fragment of the investor's decision-making process. Obviously, they were all important before, but they've become even more organized and important now. The private sector has historically mirrored the public sector's returns, and debt leverage is expected to drop in the private equity finance, and long-term holdings likely remain intact. but new investments will be cheaper and further in between. Because debt leverage is dropping, you'll see less in new investment because in the private sector, it's highly debt leverage. Leverage is transitioning from debt to equity is evident with the lack of funding and may be destructive of the growth or even the assets under management. That's due to substantial market contraction. With that, you'll see a lot less new investments, which would be destructive of the growth, and the assets under management may be lowered from people pulling out or anything like that. For investment holding companies, high valuated deals prior will be offset by buy low assets in the private sector. Assets under management is higher than ever, thus it still needs to be spent or held even with the reduction. A lot of people won't pull out at a low point, thus the investments still need to be made. Those will be a lot more diversified and hopefully get the return they're looking for still and recover. In 2008, the economic downturn is precedent for the changes in the market is seeing right now, and this means we'll likely see major similarities in the private sector because in 2008, the economic downturn caused a huge drop in everything. The private sector would follow suit, and thus now with the public sector dropping, the private sector is likely following suit.
Private equities are a medium to long-term assets. They are invested in various private companies. They can acquire about 100% stake, but still it collects a periodic return that's dividend and interest. The objective of private equities are to add profitability and a stronger financial base to the company. To be sold in a stock market, pocket capital gain on investment, and distribute among limited partners after deduction of fee. Now the question arises why private equities are a growth assets. As we mentioned in the previous slide, there are three objectives, main objectives of the private equities, plus whatever we get from capital appreciation. In addition to it, there are high return, low volatility, cash inflow from existing institution and the new investors are a good cause to make it as a growth assets. In contrast, defensive assets offer reliable periodic returns, and in most cases, the principal redemption is secured in the form of collaterals.
So when we look at a private equity firm, there's typically two people who are making a return. You have the fund managers and the fund investors. We can think of the fund managers as general partners, and they typically make two types of income. The first type of income is the annual percentage they take off the fund's assets, and the other one is a percentage they take off the investor's capital gains. The first type is considered ordinary income, and then the percentage of capital gains is considered as capital gains. Typically, this split is 2% of the fund's assets and 20% of the investor's capital gains. Now, when we talk about investors, investors typically make one type of income, and that's their capital gains, the growth on their initial investment. Dividends returned on the company's stock is typically put back into the fund and reinvested into the company. When asked the question of the best performers in the private equity sector, we can take this question in two different ways. We have the best performing private equity funds and the best performing private equity markets. Starting off with the top performing private equity firms on the left, we have the top 5 performers over the past 5 years. Together, these funds have produced over $250 billion in private equity over the past 5 years. The Blackstone Group alone has over $7 trillion in assets under management. We can also discuss the best performing private equity markets, the markets that private equity firms are typically involved in. While private equity firms typically don't constrain themselves to certain markets, there are typically trends that we can see when looking at private equity firms. So if we look at the top 5 performers and what they're invested in, we can see that there are some common markets such as the software industry, technology industry, and the financial data industry. And there are some outliers such as sports and apparel. This just goes to show that private equity funds typically look for potential for growth over all else.
Types of investors. The private equity market attracts a specific type of targeted investors with the focused requirements, whom invest directly into private equity funds. These types of investors can be classified into two main categories, being accredited investors and qualified clients. Similar in the aspect of high net income, however, differ by accredited are a relevant classification of the ability to invest in private equity, in which the entity is allowed to invest in securities that may not be registered with financial authorities, in contrast to qualified clients, where it is a relevant classification for investors who want to maximize their assets under management. These types can then be broken down further into investor types such as angel investors, institutional investors such as insurance companies, university endowments, pension funds, high net worth retail investors, and private equity firms in which are funded by accredited investors. A direct investing approach. Private equity is direct investing, where capital is obtained in exchange for equity interest. Since private equities are not listed or publicly traded, the source of investment capital is derived from investors with high capital capabilities. These types of investors or firms are not held to SEC regulations since they are typically not registered, which is a key factor as to why this market attracts high net income and institutional investors. Sometimes the strategy is to gain control over a company's operations, which requires a large amount of capital, resulting in these types of investors that have the higher capital capabilities dominating the industry. Minimum commitment of an investment of this type could start anywhere at $250,000 into the millions. Private equity-backed portfolios have to have a strong, steady stream of recurring cash flows in order to maintain and meet interest payments. This chart depicts how trends are shifting towards total buyouts and taking public companies back private. You can see how the level going private transactions increases year after year. Subfields engaged in by private equity investors. Two main subfields that private equity investors engage in are leveraged buyouts, LBOs, and venture capital, VCs. An LBO occurs when a target company is bought out by a private equity firm through debt financing, in which it is collateralized by the target's operations and assets, paying a fraction of the purchase price through leverage while helping to maximize potential returns. VCs are engaged in typically with companies in the earlier stages of development, with the intent to take a significant stake in the target company in hopes that it will scale and become influential in its industry, the main motivation being yielding high returns. In regards to risk tolerance, private equity investors have a higher tolerance due to the risk-return trade-off that is expected. Generally, the phrase, "let the buyer beware," is strongly applicable. That being said, these type of investors can still be comprised of both passive and active investors. Passive, who rely on the management to generate returns, or active, who provide operational support to management to help grow and generate returns. This can be seen when CEOs help to increase efficiencies and synergies through their expertise and network of contacts.
Risk-neutral investors in private equity. As previously mentioned, private equity has historically mirrored the return of the S&P 500. This would indicate that the overall market would be close to risk neutral, but a single investment would portray a vastly different scenario. This means a single investment wouldn't follow the exact market, just like investing in a single stock isn't going to follow the market. Minimum investment is astronomically high in this asset class, likely indicating a willingness or ability to diversify in private equity. When a minimum investment may be $250,000, it's likely that the person investing has a lot of holdings in different things and may be willing to accept more risk. ETF funds are available for lower investments in this industry, where it's on the stock market and it invests into this asset class. Liquidity issues in this case are higher associated with this class, just because it's not as easy to sell and may cause for higher risk. Ignoring investment opportunity, a risk neutral investor should invest in a low portion, say 10 to 15% of their portfolio in private equity. And this is because it is a high risk, high reward industry and it's growth oriented. And so that put a portion into your portfolio that would be willingness to accept the risk and diversify into other holdings.